Chargepoint, the electric vehicle charging company that went public via a SPAC, which retail investors had a chance to buy at $10 per share, now has 5 analyst ratings, with the lowest rating being a buy with a $29 price target, and the highest being a $40 price target, with a consensus of $27.20. All 5 saying that Chargepoint is a buy. We believe that Chargepoint's early mover advantage, due to the seasoned management team, astute sales staff, and superior products designed by the tech-heavy workforce, along with its focus on innovation, customer experience, strong product offerings, and superior service, support the company's 70% share of the Level 2 network charging hardware market in the USA. The Needham investment analyst said about Chargepoint and given his $39 price target of a buy rating this week. Needham's analyst was also joined by a Jeffries analyst who gave Chargepoint a price target with a buy rating of $40 per share. This is great news for Chargepoint investors like myself. I've always said from the start when I first started investing in this company in SBE, the SPAC that took it public last year, that Chargepoint is the ultimate pickaxe for the EV revolution. Because regardless of which EV car manufacturing company wins or succeeds in this market or loses and fails and goes bankrupt, Chargepoint will still win and succeed so long as the EV market does continue to penetrate the overall car market. Because Chargepoint is the dominant force, the leader by 7 times ahead of all of their other competitors in the EV charging space, specifically in the level 2 space. They also have DC fast charging for those cars that need that, but for most cars, level 2 is good enough, and that's what the standard is today, and Chargepoint by far leads that field. There is no one even close. The next 4 don't even come close combined. So that's why I put all of my EV infrastructure money behind Chargepoint. And I'm very happy to have these 2 new analysts join the other 3 and continue to move Chargepoint upwards, because this company, as I've always said, is a great company. Regardless of which way it went public, via a SPAC or a traditional IPO. People love to hate on SPACs because they think, oh, it's not a traditional IPO and they all are trash. But hey, if you pick trash, you get trash. If you pick the right companies, regardless of which way they go public, you can benefit from the appreciation of the value of the asset. That's all that matters, picking the right company. And I'm very happy that I had a chance to get into this company very early on when it was still a SPAC, thanks to our patrons at patreon.bullacademy.org who brought it to my attention last year. And we got in way before everyone else had a chance to. And now we're all the way up by 100%, 200%. Some of us already up 300%. So that's great, right? That's the value of investing in SPACs early on, because we never had that opportunity. With IPOs, we got locked out until the day of the IPO after it popped and we have to buy the top. But with SPACs, we get to get in early. And that's exactly what myself and our patrons did with SBE Chargepoint. So this is great news for Chargepoint and investors out there who are looking forward to growing their wealth with this company over the long term, because we're still at the ground floor. We're still only at 3, 4%, 5% penetration of EV cars in the overall car market. And in case you forgot, Chargepoint's growth is directly related to the growth of the overall EV market. When the EV car market grows, which it is by 36% a year, Chargepoint's revenues grow because more companies, more businesses will want to have EV chargers at their locations to drive foot traffic, because that's how Chargepoint's customers make their money off of their chargers. Chargepoint enables anyone with real estate to buy an EV charger from them, have them install it, and drive foot traffic to that EV charger from EV drivers. And the beauty of Chargepoint, what sets them apart from the rest of the competition, is that they don't charge for energy usage. They don't charge drivers for how much energy they use to charge their car. That's not how Chargepoint makes their money. They let the business, the charger's owner, decide how much to charge. And they can decide if they want to make money from it or just drive foot traffic. So say a Verizon might just offer a charger, EV charger, to their employees. But they still need that charger, so they pay Chargepoint to have it installed and to maintain it, to provide a service, keep it up to date. And for the software, right? And that's the other part, the other half of Chargepoint. They plan to, in the future, have 49% of their revenues recurring. 49%. That's a great deal. That is incredibly important. They're going to have 36% coming from their software and 13% coming from their services recurring. And Needham has also said in their analyst report that they believe that Chargepoint's hardware installations are basically recurring because they already have 5,000 customers. They're growing at super fast, and 60% of their existing customers rebuy their hardware, which cements their leadership even more going forward. And back to their software, their SaaS, their Chargepoint as a service, they have a roughly 100% attach rate. So whenever a customer buys their hardware, about 100% of the time, they buy their software and services package. As long as they continue to acquire more customers and sell them more hardware, their recurring revenues from their services and their software are going to be attached to those sales, which will drive more revenues. It's a wonderful cycle. And this is how they're going to get to $2 billion in revenues by 2026. At least that's the plan, when EVs account for 10% of the overall car market. That's the goal. That's the projections right now. Chargepoint is the overwhelming leader in North America for EV charging, especially in level 2, which is the most widely used level. And they have the #1 at-home EV chargers. They are winning across the board, and they're expanding to Europe. They're already over there. They're already growing their footprint, and they're going to continue to do that. That's their plan. So they're going to continue to lead here because it's very hard to steal their customers because, again, the customers love their product, they love their services, they love their software, but it's pretty hard to just, once you install a charger, an EV charger, you can't just say tomorrow, oh, I don't like this anymore, I want to put it in the trash. No, you have to go through a whole process to have that removed because it's built in to the ground. So it's pretty hard. It's a pretty sticky product, right? When you install that charger, you're likely going to keep it for a very long time. And when it's time to replace it, you're probably going to go back to Chargepoint and get a new one because they're going to continue to innovate and build better chargers. And their software is probably the best for your needs because you already know it. And of course, they don't do revenue share. They don't charge you based on energy consumption like their competitors do. Say Blank Charging, which has a revenue share agreement with their customers. That's not what Chargepoint does. They just say, hey, here's your hardware, pay us for the software and pay us for our services. We'll maintain it, we'll help you, we'll provide customer service to your drivers, and that's it. We don't want any share of what you do with your charger. You figure out how to make money with it, and that's up to you, right? We don't care. So that's what I like about Chargepoint. They are very capital light. They don't have much expenses. And over time, as they grow their software and services revenue share by driving more recurring revenues, their expenses will continue to go down because they won't have to pay to acquire that recurring revenues because they already have it. They already got that customer who is paying them every month, every year, right? Or every 2 years, whatever the contract is. So over time, their margins go up and their dominance goes up because they have the best offering. That's why they have the most Fortune 50 customers, including LinkedIn and Google. And they have the most government customers because they don't care how their customers use their hardware. They have the best software, they have the best services, and they have the best hardware. So they just say, hey, here's the hardware. We'll charge you for the services and the software. And of course, we'll charge you for the installation of the hardware one time. But after that, it's all yours. And if you need a new one, come back to us. We'll sell you another one. So I'm going on and on, but that's how Chargepoint's going to win and is currently winning. That's why they've been winning for so long. And that's how they're going to continue to drive their margins up to 42% by 2026 and 2025. Today, their margins are around 25%. In 2022, they expect to get that to 38%. And in 2024, 41%. And after that, 41% and 42% by 2026. Those are very good profit margins. And the reason it's growing over time and not just staying flat is because they're increasing the recurring revenues. The more revenue that's guaranteed in the future, the less it costs to acquire more revenues. They don't have to go sell someone to get that revenue again because it's already coming back to them over and over and over and over again. That's why SaaS companies get the best valuations. That's why you saw Snowflake get a super high valuation. right? Same thing with Amazon Web Services. They make so much money from that. Same thing with Netflix. That's why Netflix crushes their competitors, because they already have this huge subscriber base, which means that they don't have to go sell as many people on trying their service, which means in turn that they can dedicate more money to producing better content for their existing customers and to lure in more customers that will pay them on a recurring basis, and then continue that cycle and continue to dominate. That's what Chargepoint's gonna do. That's why their margins are growing so fast. So I agree with these price targets, these analyst ratings. It's a buy. The consensus is a buy. All 5 analysts have said, hey, this is a buy. It used to be $10 per share when it was a SPAC, and now it should be going to $40 per share. That's what they're saying. So everyone who tells you, hey, SPACs suck, well, show them Chargepoint. You got in at $10 per share, and now it's $40 per share because there was no IPO pop that we lost out on. We got in before the company went public, and we benefited from this pop. When it went public, people learned about it. Analysts get to cover it now and tell the rest of their hedge fund and institutional investor friends that, hey, this is a pretty good company. You guys should go check this out. And so they check it out, and they say, oh, whoa. They plan to get 49% recurring revenues, and they lead their space by 7x. And they have a unique business model where they don't care what the customer does with their hardware. We love this. Let's buy it. And so that drives up the price. So you want to get in before that happens. And that's what we got with the SPAC. That's why I am so bullish on SPACs, right? Because we've never had this before. SPACs have been around for a long time, but it's never been this popular where we get quality companies like Chargepoint, like SoFi, right? And Tattoo Chef. These have been free money for us retail investors who were able to get in early, knew about it, and bought. So that's the news on Chargepoint. And I've covered Chargepoint many times. I have videos breaking down their projections and what they plan to do in the future, how they plan to expand to Europe and beyond, and continue to dominate the North American space. So if you haven't seen those, go watch that. And of course, if you don't know what SPACs are that I keep raving about, go watch our videos on SPACs and of course SPAC warrants. According to Google, we have the best videos on warrants. So if you don't know what warrants are and you don't know what SPACs are, you should go watch our videos on SPACs, learn about that, but then also learn about warrants because they're a big part of SPACs. So the reason I'm talking about this is because this has just proven us SPAC investors right, that we were able to find great companies among, of course, there's trash and everything. There's a bunch of trash in IPOs and there's a bunch of trash in SPACs. But if you can find the right ones, like a Chargepoint, get in early at $10 per share, $15 per share, $20 per share, then once it goes public, these analysts start to cover it and you will benefit from that. That's what we're seeing here with Chargepoint. Chargepoint is growing their revenues by 46% for fiscal year 2022, 75% for fiscal year 2023. So they're growing incredibly fast, their revenues. And at the same time as they're growing revenues, they're growing their margins because their cost of revenues decreases over time because they're increasing their recurring revenues, which we talked about at length in this video. That's why I'm so bullish on this company. Yeah, it's an incredibly bullish stance from these analysts from Needham and Jeffries. So I like it. I want to know what your thoughts are. If you enjoyed the video, like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts. What do you think about these analyst ratings? What do you think about Chargepoint and the SPAC that took it public, SBE? If you got in early on SBE, or if you just recently found out about Chargepoint and if you plan to hold it for long term. I would love to hear from all of you. It's always good to engage with y'all. And of course, as always, these videos are brought to you by our patrons at patreon.boacademy.org who support this channel financially and help us keep going. They also help me brainstorm new video ideas to share with all of you. And if you would like to become a patron and support the channel financially, join us over at patreon.boacademy.org. We discuss the stock market in real time every day on our Discord channel, and we share news, rumors, and new investment ideas where we can go and do our own research and then come back together and collaborate and help one another stay in this investment game for the long term, because that's how you win, by being a long-term bullish investor. And you will have a chance at winning $200 every month just for being a loyal and engaged patron. So if you're interested in all of that, join us over at patreon.boacademy.org. I'm Lincoln with boacademy.org. Thank you again and have a great day.